Hey guys, Stock Saturday, and it's a flat week. Don't get this too often. Normally there's some sort of move. We've had a few sort of red and greens here and there, but yeah, overall it's not moved. But there has been quite a bit of sort of earnings and news come out. So it's mining week, it seems. Glencore released their preliminary results for the full year. It looked pretty damn good. I thought I would highlight sort of a couple of sections of the report. So you've got adjusted EBIT and EBITDA. Looking at EBIT, so earnings just before interest and tax. This is almost net income. You've got sort of industrial activities, so the mining side has dropped a reasonable amount, sort of 8 billion down to 5 billion, and the sort of marketing side down to 1.6 billion, but energy products up from 3.2 billion to 15.8. So as I said before, I'm now in a dirty coal miner, sort of one of the dirtiest coal miners, and the marketing side of that 1.4 billion up to 5.2. So the marketing is sort of shipping, basically, and transport of materials and goods and energy. So yeah, I still like the. I'm sort of mainly focused on the metals and minerals side, but you do have to sort of pay attention to obviously the energy side and the sort of marketing and shipment side. So yeah, good to see sort of that side of the energy side of things doing well, at least, and yeah, metals and minerals sort of slightly down, but sort of up on pre-COVID prices. So just coming into the industrial activities breakdown, as I say, this is sort of the area that I'm most interested in. So you've got copper assets, 19 billion in revenue, for 3.4 billion in adjusted EBIT, which is reasonably good, sort of 13-14% margin, not too bad. Zinc, 13 billion in revenue for very, very little in adjusted EBIT. Quite a lot of depreciation and amortization in there, so that's not too good. Nickel, 3.9 billion for 900 million in adjusted EBIT, so 25% EBIT margin, pretty good. And then you come down to the coal section and you realise sort of, yes, it's a dirty coal miner. So yeah, you take all four of these sort of main sections, you're looking at 27 billion in revenue, 15 billion in adjusted EBIT, so over 50% margin on the coal side from revenue, which is sort of, tech company margins, even very, very profitable tech company margins. So the metal side not doing all that well, but I still think that's positive for the future, and sort of hopefully some of this lovely sort of short-term cash can go into something a little bit greener. So not too bad compared to sort of last year. Copper was doing a little bit better, and sort of even adjusted EBIT margin was better. Zinc was not too bad, but still not hugely profitable, sort of less than 10% margin. Nickel was sort of a little bit worse than last year, or a little bit worse last year. It's done a little bit better this year. And then, yeah, coal was sort of 11 billion in revenue, so less than half the revenue, and only at sort of 30% margin. So it's been a good coal year, which is terrible to say, really, but there you go. You have to go where the money is. You sort of see from my portfolio, I'm not particularly ESG focused, but there you go. And you've got Vale released their Q4 and 2022 full year results. Sort of bit of a mixed bag, really. Revenue sort of up from last quarter, 11.9 billion, up from just under 10, but down on fourth quarter 2021, and sort of the total year is down sort of quite a bit. Obviously, sort of copper a fair bit down in the last year, but sort of recovering. So could see a decent first quarter, the current quarter that we're in, and then adjusted EBITDA and sort of everything else. Net income slightly down on this quarter and quite a bit down from last year. Similar with EBIT and EBITDA. So yeah, not too bad, but fairly positive going forward. And again, just looking at the breakdown, obviously still the vast majority of the cash comes from iron ore. Again, that's not had the best of years in the last year, but still sort of 9.3 billion and adjusted EBITDA of 4.7 billion. So 50% EBITDA margin, where sort of your energy transition materials, nickel, 2 billion and EBITDA of 610 million. So they do a bit better than Glencore on that, actually, about sort of 30%. And copper, 498 million. So it's quite a small section, and 165 million EBITDA. So again, about 30%. And then you have the spending still for Brumadinho, the event. If you don't know, it was sort of a very large sort of catastrophe a few years ago now, I think, and they're still sort of having to pay out for that. So eventually, that's going to go away, and sort of profit will increase. But yeah, it's still sort of essentially largely an iron ore miner with sort of future growth for energy transition materials. They're still looking to potentially split these units off. They say the energy transition materials can be bigger than the whole company in the long term, which I'm a little bit skeptical of at the moment, but I'm sure they're keen and they know more than us. We had Digital Realty Trust. So I don't cover the REITs all that often because they're generally sort of reasonably steady in revenue growth, and there's sort of not really too much to show. But Digital Realty have sort of been in a bit of a sort of mixed growth at the moment, not really growing all that much. Revenue growth has been sort of quite good, but obviously they dilute shares to buy properties, so sort of per share you don't actually get all the benefit of this sort of 11% or 16% growth on a constant currency basis. So the core funds from operations per share is actually down for the fourth quarter, and on the year it's up 2.5%, or 5.8% on a constant currency basis. I do sort of, a lot of people see this as not something to look at. It's sort of papering over the cracks looking at a constant currency basis, but I would be sort of keen to look at this when the currency isn't going in your favour. If these are sort of the other way around, 6% growth but only 2.5% on a constant currency basis, then really you're just getting the benefit from the currency, and you want to be looking at a more realistic constant currency basis. So yeah, a lot of people don't like the metric, but I kind of prefer to look at it. Otherwise you're just getting the sort of yo-yo of the currency markets if you just look at straight growth. But yes, so the sort of per share growth really is how well they're sort of spending the money that they're diluting you for. If they're sort of diluting £100 worth of shares and sort of getting 90 out of it, then we're not going to do quite as well, even if it will show revenue growth. But yeah, I still think there's sort of reasonably good long-term potential for them, and it's still what we're looking at, they've given us the guidance, sort of total revenue up quite a lot for the next year. Adjusted EBITDA sort of up 10%, but we don't really look at that. We look at core funds from operations per share, which is sort of flat, which again, people are sort of seeing as terrible, but I guess it just means, you know, they've diluted a little in the last quarter, I think it was, sort of 3 million shares, but actually seem to have got quite a bit of property for that. Property sort of increased 7 or 8%, I think it was. So you sort of see the benefit from this in, you know, future years when they're sort of raising rents and getting a positive move from that. But yeah, it's still sort of 15 times earnings, 15 times cash flow, funds from operations. So yeah, I didn't see that as too bad. And just coming on to the news, so we've had preliminary GDP numbers from the EU at sort of 0.1% for quarter four, which is ever so slightly positive and sort of not really a recession. Previous was 0.3%, so very, very slow growth. But then, more importantly, you had the US CPI numbers. So core CPI for January, sort of as expected, 0.4%. Not sure how that was slightly more than expected on the yearly, if the monthly was as expected, but rounding errors, I guess. So on the yearly, down from 5.7% to 5.6%. Not exactly rocketing down, and sort of lends more weight to the higher interest rates for longer theory. I still think they're sort of going to be coming down at some point later this year, even if they say they're not going to. And you had ordinary CPI sort of, again, as expected, 0.5% on the monthly, up from 0.1%, but 6.4% on the yearly. So again, don't know if this is rounding errors or sort of how one is right, but the yearly is quite so wrong. But there you go. Worth noting in the US that they've been fiddling with the past as well. If you notice on the sort of previous 6-month figures, we had a few sort of 0.1% here and even a negative 0.1%, and they've been revising them. So September last year was 0.1%, and they've put up to 0.2. October they've put up 0.2 to 0.4. 0.4 to 0.5 in November, another 0.1% for December. They've put the January figure, or the December figure released in January, from negative to 0.1%. And then, yeah, we've got this figure. So that sort of looks a lot more inflationary. Not sure how you can really sort of be revising September's numbers now, but yeah, that seems a little bit sort of unusual, let's say. Not sure why they would be doing that, and the sort of core numbers haven't been revised, or a couple of them have been revised upwards, but not quite as major a change. And if you sort of look at the last, few months in 2022, it's not really coming all that much down with these revisions now. So could be sort of preparation for them saying the data isn't really showing it coming down, and sort of raising interest rates again, 0.25% here and there, and keeping them there for longer. So that's potentially a negative, and I do get a bit sort of skeptical when they start revising quite so many numbers. But yeah, that's it. So you do have to sort of think when these numbers come out, they're certainly not permanent, even after a few months. And we had the UK numbers come out on Wednesday, potentially sort of even more interesting. You've had core CPI was expected to be 0.5% negative, which is not particularly good in itself. Previous month was 0.5% positive, but it actually came out 0.9% negative, And if you come to the monthly chart here, I'm not sure if this is sort of Christmas spending or sort of what it is, but if you actually look at February numbers, it does always seem to be negative. So sort of 2022, you had minus 0.4%. 2021, you had 2 negative months in a row, and 2020 was minus 0.6%. So this is bigger than all of those, minus 0.9%. But yeah, not really sure what happens in February. Whether this is just or this is January numbers, I suppose. So maybe it's just Christmas. But yeah, minus 0.9%, not particularly good. The yearly down to 5.8% from 6.3. It was only expected to come down ever so slightly. Ordinary CPI minus 0.6%. So yeah, that's coming down. Not even in single figures on the yearly yet, but there you go. And yeah, I don't think there was sort of too much else on the news side. So yeah, interesting. There was a little bit of PPI, purchaser producer price index, was sort of a little bit higher than expected. So yeah, potentially leading to sort of future inflation. I think that's a little bit more of a sort of a leading indicator. And jobless claims ever so slightly sort of worse than expected and a bit higher than last month. So yeah, on the portfolio side, it was sort of largely sort of flat. 1s and 2% up and down. Apart from Stellantis had a quite good week, about 5% up, and Taiwan Semiconductor was about 5% down. But they've sort of been doing pretty well over the last few weeks. So yeah, not too much movement there. On the ISA side, sort of a little bit better on the crypto side, Bitcoin being up, so Silvergate Capital is up a little, and my little Bitcoin ETF sort of doing quite well. The shorts still not doing particularly well, but they're just a hedge really, and yeah, the sort of the rest of it hasn't really moved all that much. So yeah, leave your thoughts in the comments below, and like and subscribe. See you soon.